Hello, and welcome to our second quarter strategy review for 2021. Looking back over the last year, we had our strategy review when I was in California, as I am now, and we all were really concerned about what was going to be happening in the markets. COVID situation was really just starting. And frankly, we had a 2-day strategy review. One, to identify how you go forward with all of these unknowns, and two, to implement an idea which I give Bob 100% credit for, the idea of finding companies that would survive no matter what in this environment. And he even gave them a name, which we used in that strategy view, and they were called stalwarts. It turned out that we were so right to be in those large companies because they have done very well during the last year. And of course, we now know that markets are even higher than they were prior to the time this all started back in February of 2020. Keeping all that in mind and keeping the same strategy with me in California, we decided we'd even extend it a bit further, and we invited a guest. And our guest actually was even smarter than I am. He was in Hawaii. So his view of the world definitely looked even brighter than mine. And of course, the fellows in Washington didn't look bad. We had a much better purview. At any rate, introducing our guest, it was Jordan Lawrence. He is an equity strategist with State Street Funds, and they specialize in SPDR ETFs, which you actually, as clients of the firm, have a number in your portfolios. His comments were very well founded, and you will hear some of those results as we go through the meeting today. I think he had some very clear thinking as to inflation, as to what was going to be happening with, the resurgence of retail and apartments and all kinds of things like that. He had some really interesting ideas. We appreciated his time with us. But in any case, joining us at that meeting, of course, was Len Skeena, CEO of the firm, and Bob Toomey, Vice President and Director of Research. With that long introduction, but I think worthwhile giving you some history, I'd like to turn it over to Bob to talk about equities.
Thanks, Stan. Thanks for that great history. I think it's great perspective. There's no question that the last year has been unprecedented for all of us, for everybody in the whole world. I mean, not just our industry, but I mean everybody. And so I think when I just add to your comments, when you look back a year ago on what people were thinking, there was a lot of talk about end of the world. There was a lot of equity strategists that went very negative at that time. They couldn't have been more wrong. Many of them, the market, and as you all know, in the end of March of 2020, just turned around and just started its very stable, straight march back up to where we are today. And we're 16% above where we were at the peak in February of 2020. That is the U.S. stock market as measured by the S&P 500. So it's been very resilient, and I think it has surprised a lot of the pundits. So, why is the market up so much? It's discounting a significant improvement in the economy and corporate profits that is being driven by the COVID recovery, which in turn has been being driven by the vaccine and also by unprecedented fiscal stimulus on the part of the U.S. government, as well as a highly accommodative policy on the from the Federal Reserve. So we sort of have this triple whammy of vaccine, fiscal stimulus, and Federal Reserve policy that has created the conditions for what we believe is going to be very strong growth in moving forward through this year and in 2022. That's why the market is up so much. And some of the economists that we follow, we are now seeing projections for GDP growth this year of as high as 7%. That is extremely high. I honestly, having been in business since the late 70s, I can't remember too many quarters of GDP that were anywhere near that high. I remember some fives and things like that, but so we're seeing unprecedented growth. And 2022 also looks very strong, looking to be in the range of 3 to 5% in 2022. So what happens in a situation like that is clearly corporate profits are turning, and corporate profits are the primary driver of stock prices. And those look like they're going to be up around 30% this year and around 15% in 2022. There have been some concerns about rising inflation. I would say that I think we share those concerns. When you look at the Federal Reserve policy and the massive fiscal stimulus we're seeing out of Washington, D.C., it does raise questions about inflation. We think there could be some transitory, temporary inflation this year, but I believe that the underlying drivers of inflation, of what I'd call sustained secular inflation, are still somewhat deflationary. So we'll have to wait and see how that plays out. So again, the underlying conditions are still positive for equities. Fed policy, strong earnings, and I think moderate inflation all continue to, I think, point to rising equity prices. I'd like to turn it over to, in the U.S. that is, I'd like to turn it over to Len now to talk a little bit about international equities.
Thank you, Bob. The international scene is very similar in a lot of ways to the U.S. scene. I mean, we're coming out of a COVID depression to a certain extent, and we are moving towards a non-COVID recovery or a post-COVID recovery. And the things that Bob has spoken about that are going to benefit the U.S. economy, many of those are going to benefit the international economies as well. There will be less stimulus, most likely, on the international front than there has been out of the U.S. government recently. And we do anticipate U.S. stocks and the U.S. recovery being somewhat stronger than the international recovery in the international markets. And to that extent, we are overweighting from our normal allocation internationals, but not quite as heavily as we were doing that in the domestic equities at this point. We continue to hold a position in the emerging markets as well. We feel that those are positioned to benefit from a post-COVID recovery. That position that we have is interesting in that it excludes any state-owned enterprises. And that's something we talked about at the last meeting, that state-owned enterprises typically have been something of a drag on the performance of the emerging market securities, and that the non-state-owned enterprises typically do significantly better. And we have been quite happy with that position, and we maintain that position going forward this quarter as well. With that, I'd like to turn it over to Stan to talk about REITs.
Thanks, Len. REITs were really an interesting topic. Actually, our guest talked extensively about REITs, and of course, he favored his own REITs, but that's okay. We, as you may recall, have consistently favored REITs because of the fact their pass-through capability of bringing us more income into the portfolio. But we have consistently been concerned about the large office spaces and, of course, the large retail. So we've tried to emphasize other areas. The third leg actually is the large apartment buildings. And again, I think with Jordan's comments, it really solidified that large apartment buildings actually in this environment could be very, very positive. Number one, they've been somewhat depressed because The government has, in effect, asked those large apartment owners to kind of shoulder part of the burden. Don't throw people out, don't raise rents, all of these other things. And as we come out of this situation, the one thing that, of course, is unique about any real estate owner, especially large apartment buildings, is they can raise rents. So that's I think, a theme that we thought very seriously about and have decided that we would emphasize large apartment buildings in our REIT portfolio. So we did add a new REIT. It's a straight real estate investment trust that invests totally in large apartment buildings to kind of offset maybe some of the other problems. Although interesting to note that Jordan was very positive on REITs in general, probably more positive than we are or were. But again, we still maintain a full position in REITs, but we've now decided to emphasize the large apartment buildings as opposed to the medical properties, which we were doing in previous quarters. With that, I'd like to turn it back over to Len to talk about fixed income.
Thank you, Stan. The fixed income side of things, as Bob indicated earlier, is in large part being driven by what the Fed is doing. And the Fed wants to maintain an accommodative position. So they're going to try to keep interest rates low. They've made it very clear that they don't want to raise interest rates for several more quarters before anything is going to probably happen. They want this recovery to be as strong as possible. And with that, we are expecting the short end of the curve to remain, relatively low and stable, but we are expecting interest rates to go up, particularly on the higher end. We're expecting a steepening of the yield curve. Some of that is due to an anticipated increase in inflation, not an enormous jump necessarily, but definitely a little bit more inflation than we have been experiencing. And when there is additional inflation, lenders typically try to raise their rates so that they can be compensated for the additional loss in purchasing power that they would have in an inflationary environment. So we will expect to see that yield curve steepening. And with that, what we have decided to do is actually something we've been doing for a while anyway, which is to skew our fixed income portfolio to the shorter durations, try to de-emphasize the long term and put a little bit more weight on the shorter term areas of the bond portfolio to take advantage of the fact that we recognize interest rates are rising and we recognize that bond prices go inversely to the direction of yields. We did add a couple of positions in our bond portfolio. We maintained one and added another. The one that we maintained in addition to our normal treasuries is in the intermediate term area. We added an international, or maintained our international bond fund, and that is something that has been giving us additional yield there. It has been doing very well for us, and we are going to continue to maintain that one. The short end of the curve, we added a position in short-term high yield bonds. That will again add some additional yield into the portfolio, hopefully in a way that will not subject us to as much of the downside should interest rates rise, since the high yield funds should be less likely to participate in that. And it is on the shorter duration as well, which again, typically is less inclined to be affected by all of that as in the same situation. With that, I'd like to turn it over to Bob to talk about other changes in our model.
Great, thanks, Len. So I'm gonna concentrate my comments, or focus them, I should say, on the equity area. I think Stan and Len both did a great job discussing the changes in REITs and fixed income. But I think there were some very interesting changes this quarter that came out of our discussions with Jordan and our deliberations in the meeting. I think one thing we did that I think is notable is we eliminated our position in what the RTH, which is the VanEck Large Retail Exchange Traded Fund. That had a fairly large position in Amazon. and some other major retailers. The investment worked out well for us, but we really feel right now that we really want to emphasize more value. We think that there's a rotation going on that really started really towards the latter part of last year and has continued into this year, where the market is kind of rotating away from higher valuation, high PE growth stocks to more value stocks that tend to be more established companies that pay dividends and have strong free cash flow. And that makes sense when you think about it. If interest rates are rising, the market is going to accord a higher valuation to a company that has a higher present value, if you will, of free cash flow or stronger sustainable free cash flow. So we think one investment that gives us that is an investment that you have held for some time. It's called Moat. It's the WisdomTree Wide Moat ETF. It contains companies that are generally larger, high quality, generate free cash flow, and also carry a buy rating by the Morningstar analysts. And this ETF has outperformed the S&P 500 significantly over its 15-year history. And we think that Moat will give us and give you a better exposure to that value tilt or that value rotation that we think is going to continue. The other interesting change I thought was the elimination of REGL, which is the mid-cap dividend aristocrats. It's done okay. It hasn't done quite as well as the index, the primary holding in that area. But we eliminated Regal and took out and added a position in XME, which is the Spider Metals and Mining ETF. Again, that was partly came out of our discussion with Jordan Lawrence. But the XME is focused on metals and primarily industrial metals and mining companies. It does have some gold-related companies as well. But we think that XME gives us better exposure to a cyclical recovery in the economy. It gives us exposure to commodities, and it gives us exposure to potential for a rise in inflation. And metal stocks do tend to have a higher correlation with inflation. And so we felt that was an appropriate move for us in that area. I just want to take a minute and talk about the triggers we set this quarter. We set triggers every quarter that are really set in what we like to think of as in a calm setting where we can really think about the risks in the investment environment and really think about things that that are usually unlikely or highly unlikely, but if the event did occur, that it would be a serious issue that might have negative implications for your portfolios. So we really try to think hard about that, so we don't have to make decisions in some kind of market turbulence or some kind of emotionally driven decision where we feel we have to act out of urgency. So we set two triggers this quarter. One is relating to the economy, if you will, consumer sentiment. It's the University of Michigan Consumer Sentiment Index. We looked at the long-term trend in that, and we feel that if that index went below 70, we feel that it would be a negative indicator for the economy, and we would probably want to lighten on equities. The other trigger that we set this quarter was related to inflation. It's related to the core CPI inflation index. And that has been bumping up. Well, there's concern that will go up. As of yet, there's really been no major indication that inflation is resurging. In fact, the most recent reading, core inflation was up 1.4% year over year, which continues to be very low. But we set a trigger. If that index goes above 2.75, we most likely will take some action to adjust or reduce equity exposure or adjust equity exposure to be more oriented towards inflation. With that, I will turn it back to Stan for closing comments.
Thanks, Bob. And thanks for the explanation on the triggers. triggers have been an important part of what we do because we are looking forward 1 quarter with all the information that we can gather at the time on a 5-year time horizon. So things within that period can change. They don't change often. And historically, we have had triggers activated only actually 4 times. And the 4th one was last quarter, which was an interesting trigger. And I'd just like to quickly review it because we looked at, when we talked about our triggers last quarter, we looked at a concern that we might see short-term interest rates or interest rates on the 10-year bond specifically rise. And if they did, we were concerned about what would happen. They did rise. As a matter of fact, they're now up at 1.75 on the 10-year bond. Doesn't sound very high. It is high relative to where they were just a quarter ago. But when we looked at that, so what do you really do? And the answer was, you need to be cognizant of the fact that bonds are going up in yield. That means bonds are going down in price. And we took that action during the previous quarter. And we continued that action, as you heard from Len, this quarter in a recognition that those interest rates may still be rising. However, we did specifically look at the fact, is that really a negative for stocks? And the answer was historically, no, it's not necessarily a negative for stocks. But we took no action in the equity area. And that also seems to be holding true. At any rate, thanks again for tuning in. We hope to see you again next quarter. Again, referring back to a year ago, a very different view. We are really, as you can see, pretty positive on equities. We're pretty positive on the stimulus, all the other things that are going on. And so we go forward into the next quarter with a very positive point of view. And you'll see that in your portfolio transaction, which will be coming out shortly. So again, hope to see you next quarter. Thanks for tuning in and have a good day.